You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Good morning, everyone. Welcome to our final home stretch of this year's 2019 OIC. We've had a couple great days, and today's going to be hopefully equal. A few panels today that are going to be very interesting. We opened this morning with a panel on clearing and execution, the challenges of being in the U.S. space these days, followed up by a very interesting panel on institutional execution and liquidity. And we have featured speaker today, Anthony Scaramucci, will follow. And then later today, we will be having our first Crowd of Fame induction ceremony to recognize our lifetime achievement contributors to the option space. All very exciting. So right now, I'd like to introduce Ravi Jain of Sterling Trading Tech. And Ravi will be talking about his company, and then they're a sponsor, and then introduce our first morning's panel. Thank you.
Good morning. It's great to see more than a handful of people in this room after last night's great dinner. So my name is Ravi Jain. I am head of risk and derivatives at Sterling Trading Tech. Many of you might know Sterling traditionally as a platform provider. But over the last several years, Sterling has been transitioning itself into a much broader fintech company. And today we not only provide multiple platforms, but full back-end architecture for trading, infrastructure, risk, and compliance products. And in fact, over the last couple of years, last year or so, we've launched some very sophisticated cutting-edge risk technology. Last year, we launched a cloud-based risk product, pioneering risk analytics as a service. This product has attracted significant interest from a variety of players in the market today. So we're quite proud to sponsor a panel on the risk challenges or challenges faced in risk management by clearing firms. Thus, I'd like to introduce our moderator today, Steve Crutchfield, who's head of market structure at CTC Trading. Steve?
Good morning. Morning, everyone. Thanks, good morning. Anyone else? Well, this is great. I'm very happy to be here, and thank you to MIAX and OIC for having us this morning. And I have to say, I'm impressed with the turnout. When we were asked to do this panel Friday at 8, and my first reaction was, well, that's not exactly the primo time slot, and I didn't know what kind of a crowd we were going to have. And then I realized that our friends at MIAX and OIC had done something that was absolutely genius, because if there's one topic that's going to get people out of bed on a Friday morning in Miami to come to a panel, it is clearing and risk. So thank you, thank you. So this is great. I'm Steve Crutchfield with CTC. We're a derivatives market maker on a variety of markets in the U.S. and Europe. And why don't we just go down the line and we'll have the panelists introduce themselves.
Sure. Good morning. Kevin McCarthy, Bank of America Merrill Lynch, professional clearing, or Frank would know us as Wagner Stock Clearing Corp.
Good morning. I'm Alicia Crighton. I'm with Goldman Sachs. I'm the COO of our options, futures, and OTC clearing businesses.
Hi, good morning. My name is Mike Dennis. I'm the U.S. Head of Relationship Management for ABN Amro Clearing Chicago.
Good morning. Frank Magnani from Interactive Brokers. I'm responsible for sales.
All right, great. So I think without being too self-serving, it's probably accurate to say that our options industry here in the U.S. has an exceptional track record at central clearing and risk management. Certainly going back through the financial crisis, the years since, the industry's been very, very stable. We've seen OCC build an excellent track record as central counterparty now for decades with 20 exchanges and platforms connected to it. Even just looking at the structure of the market, although certainly we all have issues and challenges that we discuss at this conference and elsewhere every year, through the quality of the lit and displayed and immediately executable markets on screen. The U.S. options market, I think, really sets the standard, and when we at CTC trade on markets on a variety of platforms internationally as well, and we often point to the fungible, centrally cleared nature of U.S. exchange-listed options trading as being a really healthy market structure for others to emulate, and that certainly includes both the central counterparty at OCC as well as the clearing institutions, including those represented here on the dais today. But all that said, of course, there's always room to get smarter, and that's really what we're here to talk about this morning. How can we continue to innovate and improve as an industry when it comes to the clearing and risk functions that are really central to our ability to operate as a market. And by the way, something that we talked about in kind of preparing for this panel, when we talk about risk can mean any number of things and comes in many different forms. Certainly we have clearing risk, we have operational risk, needless to say there's market risk. And this is a great time to discuss some of those topics because looking back, certainly over the last bit more than 12 months, but we've seen some massive price dislocations in the market. We're not really here to discuss market risk today, but that has implications on all the kind of pieces of the infrastructure, moving on through the back office. So I thought what we would do to kind of get the conversation going is start off with a quick lightning round, which is an idea I stole from Alicia, who moderated a panel at FIA Boca and started off in a similar way. So I think what I would do is I would ask for just quick letter grades on a couple of topics. We'll just go down the line one time, but I would ask you each to give a grade A through F on the health of the industry's clearing function today. And also how you would grade our ability as an options industry to manage risk, which I'll let you define in your answer however you think is most useful.
Sure. So I'd say from a clearing perspective, I'm going to give it an A. And I think the reason for that is, excuse me, if you see what happened last year, we thought January was going to be huge, and then we had that massive spike in October, November, December. The ability for the clearing houses and generally the industry to support that type of volume growth, a huge sell-off, a market change in that regard, provide capital, support RWA concerns and considerations, be able to leverage and have scale to facilitate that amount of volume. I think from that perspective, it's an A. From a risk perspective, I'd give it more like a B or a C. I think because operational risks do continue to scale up. When you see that amount of capacity, there's cost to that, right? So when you think about RWA and capital, it's not free. And if the largest bank clearing firms and other clearing firms are posting that collateral, I think that's a risk to the industry. And I think some of the challenges that we had around the clearing fund at OCC, presented a lot of challenges in the last year. And if they hadn't been resolved, we could have had a very different outcome to last year.
Thanks. I think I agree with certainly a lot of that. I think from an overall kind of responsiveness standpoint, I would agree with the score of the A. I think, given the spikes in volatility, the stability of the industry around their responses to those spikes, I think we weathered it as an ecosystem particularly well. So I think absolutely that gets an A. From a kind of, where do we go from here? How do we think about what the forward is? I would kind of give that a C+, probably trending far more positive than I think we would have felt probably 18 months to 2 years ago.
That's great. Yeah, I would echo similar thoughts to Kevin and Alicia. I think last year was, pretty telling of how strong the clearing industry is as a whole. So I would probably give it an A as well. I think if you look into a little bit deeper the capital or the risk associated with it, I would probably be on the page of maybe a C. I don't want to say C-, but maybe just a C. And then if you even take it a step further into specific asset classes, particularly clearing equity option market makers, there's some worry there, just because there's not many. There's only 3 of us, and so you could probably give it around a B as well. It could be improved with some more competition.
Yep.
I look at it 2 ways. Number one, I probably would give the OCC an A in managing risk. And then the area that I think where I can see improvement is at the member firm side, the broker-dealer side, in managing the risk of many of the clients that are on their platforms. So that's the way I would look at it.
Great, thanks. And we'll, I expect, touch on each of those topics in a bit more detail here throughout the panel. By the way, I'll just comment quickly. I'm glad that nobody awarded a grade of E. I think when you ran this panel, right, there were we had a couple of colleagues from outside the U.S. who awarded grades of E. But overall, it seems like that's actually a pretty good scorecard, although a bit of a divergence on a couple of the topics there, and we'll come back to that. So the issue of clearing, Mike, you just mentioned the issue of competition among clearing firms, which I agree is an important issue. I think John Fennell actually brought it up as a concern yesterday when he was talking about the fact that we do have just the 3 firms who are currently very active in offering clearing services to options market makers. So Alicia, maybe I'll start with you on this. Kind of ask you a question that might sound a little bit silly, but do you wish you had more competitors in this space? Is there enough competition in the options market making clearing space to form a healthy ecosystem?
Yeah, and every time I say this, it's, to your point, such an odd statement to make. I absolutely wish I had more competition. It's not a great feeling to sit there and know that there's really only 3 of us that can facilitate options market making clearing. I don't think it's good for safety and soundness. I don't think it's good from a resiliency standpoint. So I think it's pretty challenging for all of us to know that there's only 3. I think the barriers to entry are significant, not only from a capital perspective, but I think from an infrastructure standpoint as well. It's a fairly nuanced business, what you need from a system stability and capacity standpoint, what you need from a risk management perspective. So as we've seen over the years, there are a number of firms that have tried and thought about kind of breaking into this space and then have decided to pull back for a variety of reasons. The capital component certainly didn't help that case either. So I absolutely wish there was certainly more competition from a clearing firm perspective, that there were new entrants in the space. And I think it would be great if there were new entrants from a market-making perspective as well. Yeah. I think it's also challenging if you're thinking about, do I want to be in the clearing business? And you look at what some of the challenges are, what some of the requirements are, and then you look at what the growth opportunity is. When volume and volatility are at the levels they're at now, there's not really many firms entering this space. It's a really tough proposition to say, yes, this is a business I'm going to run at.
Yeah, the barriers to entry are certainly high across the board, and for your clients as well, to your point.
Absolutely.
Mike, how about you? You're in a very similar space. Are you? What are your thoughts on that? And are you kind of adding clients, or are you sort of offboarding clients right now?
Well, I think one thing to add to Alicia's point is that not only is it capital intense, but it's also there's a challenge to find people who actually know how to clear equity option market making. And I think if you look at some of the DNA of the folks on the panel here, like our DNA is deep rooted in O'Connor, which was very much an early equity option market clearing firm. I think Goldman had, first option and, things of that. So everyone kind of has that in their DNA. So in order to build out your back office to do equity option market making clearing, where the traffic literally needs to be segregated from the rest of the population, because there's different buy-in times, there's different locate requirements, that expertise is not readily available. In terms of, onboarding and offboarding clients, it's been challenging for us. We're continually, always looking at our client pool, not only with the current, requirements that we're kind of held to in SEM versus SACR world, but we're always making sure that, our clients are going to fit within our profitability metrics. So, when we look at any client, we kind of start with the portfolio. We run the portfolio through our risk metrics. It gives us an output, and we see what our capital requirements are going to be from a firm, what our clients' capital requirements are going to be, how taxing that's going to be on our back office, what the risk-weighted assets will be, and then we kind of go from there to say, are we going to, have a healthy return on equity? In certain asset classes over the last few years, particularly because of regulatory requirements on the capital side, it's been a little bit more challenging. So we're definitely in the business of onboarding clients. We just want to make sure we onboard the right client portfolio.
Right. Kevin, you want to add anything?
No, I would say that what Alicia and Mike said is really spot on. I mean, the diversity, I think, has allowed us to stay in this business and allowed us to grow. We don't only clear options market makers, we clear a global business. I think that diversification helps both from a capital perspective, a leverage perspective, a risk netting perspective. If you look at it from a CCP perspective, we post collateral to OCC. OCC only sees risk that's associated to that. But there's a much bigger construct to this. And so if we didn't have that construct and our clients weren't really more diversified, I think it'd be a much more challenging situation. So I think, do we want to see more competition? Well, there's two ways to answer that. I think it's always awkward, but yes, I think that it is a bit concentrated. And I think that's the concern that John brought up, as you mentioned. We all have that same concern, but I think from a competitive perspective, we're also bringing on business. So we've brought on business in the last year, even through some of the challenges that we saw. We continue to bring on business. We diversify all the time. We look for that ability to do so. But we're all talking pretty much to the same people anymore. And that's what's very different now. There aren't a lot of new large groups. Now you'll see some transformations taking place, people moving into ETFs, some people moving into options, but you have to be in options market making in a pretty big way to actually be substantial and to be able to have a space in this industry. So I think that's a bit of a challenge.
Right. Yeah, that certainly makes sense. And Mike, to your point, I mean, you need to obviously be able to onboard clients who you think will satisfy the right risk characteristics, but also, if I'm not mistaken, I think you're all in the business of making money at the end of the day, and we all kind of talk about clearing as a service, which it is a vital utility service for the industry, but certainly at the level of your firms, obviously you need to be able to earn an appropriate return on equity so that the business makes sense for the large global organizations in which you sit. Which is my very graceful attempt to turn the issue back with a little bit more of a spotlight onto bank capital rules. And Ariane, I think, described me yesterday as the person who's most passionate about SEM or something in the room, which I don't know if that's true, but certainly I think the issue is really important. And I'll just do I'll do 20 seconds on this because not everybody thinks about this every day as much as some of us probably do. So I think the quickest way to describe the challenge that we see in the derivatives markets with the so-called current exposure method, or SEM, which people just kind of name drop that and I think don't always kind of think about what exactly that means or why it's so broken from our standpoint, is just the simplest example is you think about being long and out of the money put spread. So as a derivatives trader, as a market maker, you have a position where you're long a put that's out of the money, and then you're short a lower strike put. So if you don't hedge that position, that's a pure insurance play, right? Other than the premium you pay for the position, effectively, all that can do is make money if the market sells off. But from a regulatory standpoint, from a capital assessment standpoint, when you look at that position under the current exposure method, that short contract is assessed the capital charge. There's no netting against the long contract, even though it has a higher strike, even though the short contract can only incur a loss after the long contract has already incurred a profit. And so the math it doesn't make sense that would be a position that would be penalized under the rules. And part of the reason that's so impactful to the market making community in particular is, as a market maker, you're sort of buying something and selling something, and you end up with a position that looks very flat at the end of the day because we're not interested in taking market risk at all. That's not our business. But particularly in products that have a lot of strikes and expirations, you end up with a lot of netting between longs and shorts. And that netting is not recognized under the rule. So all of a sudden, our clearing partners end up with what looks like a lot of capital utilization that shouldn't really be necessary. So maybe on that point, Kevin, I'll turn back to you. Could you inform us of your position on the Fed's proposed adoption of SACR, the standardized approach for counterparty credit risk, which has been proposed by the Fed, and what you see as the path forward there?
Sure. I mean, I think it's a bit of a longer story, as you kind of alluded to. I think that this has been a significant challenge for the industry. It is somewhat discrete in some ways because it affects certain participants more than others, especially this particular community. A lot of work was done to try to accelerate aspects of SACR, as you're aware. We met with the Fed Banking Supervision Group to try to accelerate, to try to identify and really recommend some proposals. That was not, really taken up, and due to some of the regulations and also cross-agency considerations, that wasn't taken. But at the end of the day, a lot of our policy teams collectively have been working on kind of the modification of SACR, because as you know, what might be effective to remove SEM, which is really the biggest problem for this community, also has a negative effect to other derivative products. So from a bank perspective, if I'm thinking about it from that level, it could have more harm than benefit. If I were sitting just in the clearing seat and I had the ability to say, extract this piece of SACR for the market maker option community, perfect, we're great, golden. So I think the benefits are there, but I think that's why there's a slow adoption. And so a lot of the policy teams are working diligently to modify as best they can. I think they've been very engaged. We had some really good meetings on this. And I think that what we see is probably through the end of this year and early into next year, we'll see an adoption. I don't know to what level yet, but there's a lot of work that's being done to correct that.
Good.
Yeah, I think I'll echo all of that. When we think about it from a Goldman perspective, I think similar. At a firm perspective, there are obviously a lot of challenges across the different groups. Some groups, like the clearing business, benefit substantially from the adoption of SACR, and we're kind of first in line to say, okay, guys, as we talk to our policy teams, when can we actually roll this out, and when will we see the benefit? There are other groups that are not impacted quite as positively, and the advocacy around that, certainly for some of the commods desks. The interest rate teams, there's a lot of discussion, a lot of heavy advocacy going on, and both the comment letters that I think we've all written, as well as the comment letters that the industry at large has written, I think really highlight all of those points. So while I think it certainly is far better for us, and it is a much more rational recognition of the risks that our clients bring to the market and how we think about it, it's definitely not a perfect rule yet. So it'll be interesting to see how this gets phased in, what the Fed actually takes on board in terms of the advocacy that's been put out there. So I think we're continuing to hear that August will have a final rule, and then we'll watch how the implementation goes. But I think the kind of critical point will be the advocacy between here and August, and what actually gets implemented into that final rule.
And I'll come right back to the timing point in a second, because I think you touched on something important there. And that does seem to be the case. If you look at the comment letters that have been publicly filed from a large array of institutions, we've commented. I think most or all the options exchanges have, certainly the banks and some of the global interest groups as well. The theme that seems to have emerged in a lot of cases has been, yeah, we should do this. This is good. The SACR methodology is more risk sensitive, but the devil's in the details. We should talk about calibrations, right? There are kind of some parameters in the model that may not be appropriately set when you look at risk across assets. So,
Sure.
So there's a lot to do there.
There's a lot in there. That's great.
So you guys all run global organizations as well, and we talk a lot about the Fed and what the Fed's position is on this, but also the ECB obviously plays a role, and Mike, you've got a European-based entity. What does the path look like for the ECB on this issue?
Well, to take a little bit of a step back, for us, when it comes to SACR, we're all for it, and we're in a little bit of a different vein up here than some of the larger banks. We're a bank clearing firm, but clearing is kind of a shining star within our organization. It excels in our business, and it's one of the most profitable divisions of AB and Amro. So we're all for SACR, and we've seen portfolios in the equity option world where we'll run someone's portfolio under a SEM model who's making markets in SPX, for example, where the requirement under SEM is 1.2 billion, and if you look at it under SACR, it's 100 million. And so we are kind of eager to have the adoption of SACR, take place. Although we are going to tread lightly, it's not that SACR will be implemented in happy days. We'll just be onboarding tons and tons of customers. The devil is a bit in the details. From the European side, there was a bank legislative package that was approved by the EU Parliament on April 14th. And that package kind of included the ability for us to now, make the rule change from SEM to SACR. And so that language needs to now get buttoned up and get approved, and we think there'll be another vote this month, May 14th, with the adoption being in 2021. Now that seems very, very far away, And I think that, as a state within the European Union, we can go to our central bank, which is the Dutch National Bank, and say, hey, we'd like to adopt this rule a little bit earlier. What we don't want to do, and I think everybody up here will agree, is we don't want any sort of like geographical arbitrage where the Fed moves first and the ECB's behind, the 8 ball a bit, or vice versa. I think we can all agree that that would be pretty detrimental to the industry and pretty detrimental to our clients. And as Kevin mentioned earlier, we're all very much talking to the same people, so we don't want to kind of disrupt that ecosystem.
Yeah. Kevin, I think you had something to add a second ago. I'm sorry.
No, I was going to say, I think also as in respect to, CEM and SACR, I think that we talked about this in the opening. I mean, I think we've all tried to do what we can to sustain the volatility and liquidity in the industry. And so I think our allocation of RWA, I mean, look, it's expensive capital, okay? And that's been one of the challenges. So we want those expenses to come back out. We talked about the fact that there are challenges to get into the industry. That's been one of them, right? So there's a benefit to you guys, there's a benefit to the traders, but I think that the ability for all of us to kind of manage that process through this has been actually pretty good.
Yeah. So you touched on, Alicia, you touched on the topic of timing for a second. So would you see yourselves, if there's an August effective date, and we understand the proposed rule had said, there would be the option for individual banks and institutions to begin applying the new methodology right away, or potentially to wait for some compliance window, maybe a year. I think the initial proposed rule might have said June of 2020, July of 2020. Where would you see yourselves in that spectrum in terms of taking action? Yeah,
I'm not sure yet from a firm perspective. I think my policy team is potentially going to stop taking my calls shortly. Because they know Friday morning when I'm not on a panel at 8 a.m. That I'm usually calling to say, hey guys, how does it look? What do we think timing looks like? And I know they're obviously trying to, with the variety of ratios that we have to report and conform to, there's obviously an optimization effort that goes on there. I think the difference for us in the clearing business, and we've already started this, is we're starting to, SACR, as much as it's been part of the vocabulary for years, it's very much front and center in terms of every conversation that we have internally and every conversation that we have externally. So while I think of the implementation as a firm-wide issue that the policy team and senior management will figure out and optimize from just a broader ratio perspective, we're very much thinking about it as this is the cost of capital to the business, and this is the cost of capital today, and I'm going to take a much longer term view on it. It's not about spot, it's about what is the long-term view on this, and because of that, then I think it gives us a lot more flexibility. I've joked around internally that I had to remove SACR from a lot of the business plans that I would write. So 2014, 2015, it was in there and the optimism was high, and then after a while they were like, why do you still have that on there? So I had taken it out, but now it's sort of front and center and part of the vernacular again, which is great. So I think the firm will do what it needs to do and it'll manage, but we're already kind of bringing it into our discussions.
Yeah, I think to Alicia's point, we're kind of on the same page where we're reporting SACR numbers now, even though we're not really held to SACR. And when we look at portfolios that we are potentially going to bring on board to ABN Amro for clearing, we're running a SEM number and a SACR number to see how it will look, so we can kind of anticipate in the future, what the return on equity will be for this particular client. And there are some portfolios that do not look that great under SACR, and so we're still keeping our finger on the pulse there. But I would kind of echo the same thoughts. We're eager but treading lightly.
Yeah. I think we all spent time. Sorry to interrupt. We all spent time over the last few years as we understood what SEM treatment was, and it came down into all of our individual businesses to figure out how to work internally and with our clients on how to optimize the rule set. So I think we're just at the beginning stages of that with SACR, right, where we don't even know. We know the kind of high-level rule set. We know what it will get implemented, or we have some thoughts on what gets implemented for us. But I think then the interesting part becomes then how do we optimize even further around that. So that'll be interesting as well as to where we go from here. Sorry.
No. I think the important part that we actually didn't mention, and I think it's important to give some credit where it's due also, is on compression. So I think that, if you look at what happened, right, we all had to come up with some calculators, which is ridiculous. And then, to throw it away later, hopefully sooner than later. But also that there had to be a compression mechanism to try to help reduce some of that drag. And I think that's been helpful from an industry perspective, but it's it's lagging, right? I mean, we had to get in front of that. It took a long time to implement. And I think that, the agility of the exchanges and CCPs to try to help with that is really important, because when we have a crisis, it's about how quickly we can remediate. And so I want to say that the compression has been helpful. It doesn't help with everything, but I think it's a smart way to address what has become a longer-term problem, not a short-term fix that everyone was kind of expecting.
That's a really good point. I think part of the reason that we've been able to manage through this, although this is a major challenge in liquidity provision right now, is that the exchanges have taken some steps over the last couple of years. SIBO and then more recently CME did a nice job developing compression mechanisms to allow firms to try to take off this sort of non-risk, but that nonetheless is driving up these capital charges.
Right.
Yeah. Great. Yeah. So we'll before we pivot off that topic, which we will do now, but I would just add a reason that everyone in the room should really care about this is it all gets a little wonky in these capital rules, and people keep talking about this issue. And why does this matter? Ultimately, and I think this is true unanimously of liquidity providers, particularly in the index option space, where again we do have that proliferation of strikes and terms. All liquidity providers effectively have to build a charge into the bid-ask spread for the difficulty in managing positions subject to this rule, and for the kind of artificially heightened capital requirements that apply. So I think it's very safe to say that the moment that this goes away, and realizing there's a process involved, and different institutions may move at different speeds, we certainly all hope to avoid that geographic regulatory arbitrage, which would be absolutely a mess. But assuming that we can get there expeditiously, we'll very quickly see all else equal, I think a tightening of quoted markets and the products that are most impacted by this issue, and that ultimately matters to everyone in this room. So moving on to another topic, and we just talked a little bit about the exchanges. So another source of market risk for some, probably operational risk for others, is the way erroneous trades are handled. And a ongoing topic of conversation in the options industry is the obvious error rules. There was a fairly substantial refactoring of those rules, I think about 5 years ago now, might have been 2014, that those rules became effective. They were harmonized across exchanges, definitely improved in many ways, but there's still more work to do. They're certainly due for a refresh. Among others, the listed options market structure working group is taking a look at that. I oversee a subcommittee there. We've made some recommendations to the exchanges on some refinements to the rules, including making some enhancements to the way obvious errors are treated, particularly around openings and reopenings. We've made the fairly obvious recommendation that it would be ideal if there were a central submission portal, a management system for trade review requests and oversight. So be interested in hearing about, and Alicia, we'll start with you, the potential cases that concern you the most about the way error handling is done by exchanges right now, and areas in which, from your perspective, we need to do better.
Sure. Yeah, the two places that we focus on a lot from a clearing perspective are, and you just mentioned one of them, the idea that there's really no central platform for this. So I think one of the benefits, and certainly the set of rules that were rolled out, were a significant improvement. So I think that was a job well done across the industry. So we're in a far better place than where we were. But I think in terms of kind of what the forward of that rule set looks like, having a central repository or a central tool to manage submissions, particularly across multiple exchanges. I can imagine in a time where there's a particular event that is stressful for the market, having to manage to multiple different rule sets, multiple different timing cutoffs, multiple different submission requirements across exchanges could be really problematic, and you would hate to see a loss because you missed a cutoff. And while I know there are overrides built into all the rules to compensate for that, I think it would just be far easier and cleaner for all involved to have a central repository for that. So a more consolidated tool would be helpful. And I think the other place that we spend a lot of time focused on is the notion of the significant market event. Really like the concept. I think it did a great job in giving the exchanges the ability to coordinate. I think what we did hope to see was a more deterministic outcome. So in terms of kind of the menu of options that are available, an event triggers this SME categorization, the exchanges can coordinate, but the auto bust, which was kind of the way we think about it, is just one of the things that the exchanges can do. And I think from our perspective, we'd much prefer to see the auto bust being auto, right? And I've heard the moral hazard argument over the years. While I understand it, I'm not sure I can picture while an event is unfolding, particularly in a matter of potentially milliseconds, or somebody at dinner last night used picoseconds, that you're actually sitting there and letting it run to make sure that you trip over the SME criteria. So I'm not sure that argument kind of really carries a lot of weight with me at this stage, and I think having that certainty, particularly at sort of minute one, I think would be refreshing for all of us.
So what you're referencing there specifically, I think so everyone's aware, is the significant market event rule, which all the exchanges have now, has a set of criteria where if an erroneous trade event gets large enough, it qualifies for the special treatment. And one aspect of that potential special treatment is exchanges, for an event of sufficient magnitude, have the ability to rule that this is, I think there's a word like infeasible in the rule set, I've forgotten the exact language, but if it's infeasible for the exchanges to address it in a timely manner, they can simply bust all of the potentially erroneous trades. Mm-hmm. And that can only happen if the event gets large enough. Right. So there hypothetically could be this kind of perverse incentive that if the event gets bigger, then maybe it'll be busted, and that would be
that's better, right? Because then your maximum sustained loss is, I think it's 30 million, right? So, when the rule set first came out, everyone's like, okay, well, max loss now for a risk issue on, across the exchanges is 30 million. It's like, well, potentially. So I think having that kind of more deterministic, I think we're just better off from an industry perspective to know, like, we're actually capping what those potential max losses are.
And to your point, the flip side of that is, it's not deterministic. You could have an event that's larger than 30 million. The exchanges say, oh no, we can handle this. It's not infeasible. So those trades are going to be subject to normal, obvious air treatment.
That's right. That's right.
Anyone else on this topic? No? Already covered. Okay. All right. Well, definitely something that I know the exchanges are working together now, I believe, through a cross-exchange, obviously, our working group, to try to figure out how to keep those rules aligned and apply them a little bit more in a better way going forward, in a smarter way going forward. So something that we haven't touched on that much, Frank, you mentioned it in your first remarks when we did our lightning round, is member firm risk. And we've been talking quite a bit here about the OCC, clearing firms, exchanges, but obviously a hugely important part of the ecosystem is risk management by the individual member firms. And the way those firms manage client risk on a day-to-day basis is obviously critical. So Frank, starting with you, how do you keep up with all the issues there, technology, redundancy, modeling risk you have to deal with at your firm?
Well, as many as you know, you had the opportunity to listen to our founder yesterday.
Yes.
And as you know, Interactive Brokers is somewhat different from some of my colleagues on the panel. We're a global execution firm. Everything we do is fully automated, as well as the clearing. And to really understand how IB operates, I'd like to share some statistics with you and some of the products that we trade. Our average daily volume electronically is about 830,000 trades a day worldwide. We have 630,000 accounts across the globe. Our client equity is 151 billion. Our asset classes that we offer on the trading platform are global equities, global options, global futures, Forex, bonds, metals, ETFs, and contracts for differences. Today, the firm is connected to 120 markets. We're in 31 countries, and accounts can be funded and traded in 23 currencies. Our website is translated into 9 different languages. That's the type of client base that we have. The clients that we deal with are primarily broker-dealers, fully disclosed, non-disclosed, omnibus, proprietary trading groups, hedge funds, financial institutions, domestic and international, and of course, retail. We employ from an oversight standpoint, we employ about 125 full-time compliance and legal staffs. And you know that's not very good if you're a salesman, when you have that many lawyers and compliance guys standing on top of you. Our support hubs are located in Greenwich, Chicago, Zug, Switzerland, London, Mumbai, and Hong Kong. And the other thing that Thomas mentioned, and also, as a member of the OIC roundtable, the way to control risk in the beginning is through education. So right on Interactive's website, we have many, many modules. One of them is the Traders Academy, which is an elaborate portal that talks all about the different products. There's videos, and also we force, if the clients want to, they can take quizzes and really understand the different products that we trade. Secondly, with regard to risk, also on the website, there's an elaborate discussion about margin, Reg T versus portfolio margin, the risk associated with both, the risk associated with day trading, all sorts of different examples. For a number of the professional traders, we know that they don't like to look at videos longer than 5 to 10 minutes. So we have plenty of short videos on the platform that enables the client base to look at the different products and really understand the risk. Then when we get down to the trading system, the iBrokers, whether they're fully disclosed or non-disclosed, we can give them a product which enables them to monitor the risk of all the accounts that are currently under their jurisdiction within their broker. We also have within the TWS trading system, we have an application called Risk Navigator. So TWS is a system that Thomas actually referred to yesterday. It's a proprietary system of IB. It's been around for 41 years, time tested. And in addition to being connected to all the different markets and having the ability to trade all different asset classes in one account, you also have the ability to test your thesis or your trading strategy prior to implementing it right on the trading platform. And one of the flagship modules that we have is called the Risk Navigator. It's a real-time market risk management tool platform, which enables a trader or an advisor or a broker to really measure the risk of his portfolio. You can measure the risk by a position, you can measure the risk by a country, and there's all different things that you can review prior to actually executing that order. And then as far as evaluating, going on the trading system, we are very different than a lot of the member firms. And when I was running my mini prime business, I cleared through a number of firms. One of them in particular was Merrill Pro, which I thought did a very good job. At IB, we have no margin calls, zero. So we monitor risk on a real-time basis, and you have plenty of opportunity not to get yourself in trouble. The trading system, in the event that a position gets out of line or your portfolio gets out of line, you'll get a notification. If it continues to get out of line, the outer portion of your trading platform will turn to a light yellow. If you still don't act, it turns to a dark yellow. And once it turns red, it's too late. You're automatically auto-liquidated. Wow. And all of the traders know this. And I tell you, from the standpoint of when I was managing the mini primes, I worked for an exchange, I worked for broker-dealers, and I managed my own business. It's a pleasure not having to make that call. You have a day trading call, you have a margin call. You don't want to do it anymore. And it takes a little time to get used to that, but we're very pleased with the way we manage risk. And as you know, Interactive Brokers is really risk adverse. And I think that comes from all the years that we were Timber Hill prior to becoming a broker in 1994. So that's how we do it.
But it was great, by the way, and thanks to MyX and OIC for hosting Thomas and Blair yesterday. I thought that was really the highlight of the conference so far, at least for me. Other than this panel, which is quickly reaching a similar level, but we're not even done. So,
but I may also say that we don't force everybody to use our trading platform. Right. I can't walk into a dealing room and say, hey, You guys got to trade on us. We're connected, fixed connected to over 25 platforms. And the gentleman that kicked off the discussion, we're connected to Sterling and Ready and some of the institutional systems as well. So we enable them to do that. But still, we stay on top of the risk throughout the day.
So I want to get back to a topic that Kevin, you touched on right at the beginning when we were kind of going down the line, an area where some concerns were expressed, which is you talked about the clearing fund. Yep. And somewhat related to that, there have been some recalibrations in risk models at the OCC over the course of the last year, certainly since the market volatility we experienced. Anything interesting to discuss there, or thoughts you have on how we could do better as an industry?
Sure. I mean, I think I'll touch on Alicia's point earlier. She mentioned, I think the industry was trending more positively, and I'd like to say that is the case. And so when we score where we sit, I think that there's still a lot of challenges. I think there's a lot of improvements that we can still make. What was exposed to the industry, and I think it isn't really understood generally by the population, it was more effective at the clearing firm level of OCC, members, was the clearing fund methodology that got exposed as a problem in late of 2017, say like third quarter, fourth quarter of 2017. And at one point in time, I think John Davidson mentioned this yesterday, we had reached almost 18 billion in collateral that was required at OCC, which is proportionally distributed across all of the clearing members. We try our best to protect our market participants, our market makers, our clients from those types of issues, but this was a massive, massive issue. And I don't think it should be taken lightly. I think that what I will say is OCC, I think some of us here on the panel, clients certainly to some degree, and the SEC worked really diligently to get that approved. The change in the rule that was really required, that replenished about $3 billion in capital back to the banks in a big way, was important. And that rule change by the SEC, which we actually spoke to the trading and markets team, commended them for a quick rule approval, was really important. But I think it demonstrates some of the fragility in the operational process. And we talk about the CCPs or exchanges, some of the infrastructure, you build trading systems and you may not always have all the analytics. Frank talks about analytics to protect his clients, but we don't always have analytics that are transparent to us. So we build our own analytics, right? And if you're a CCP and you're sitting here and looking at that one construct, and we look at a strategy base, they're not going to be equivalent, right? So we see the risk in our client's portfolio as normal and not a challenge. And yet these models, like CEM, and in this particular case with the clearing fund methodology, was really punitive and very misaligned to what the actual risk was. And that cost comes back to this industry. So if we had actually distributed that allocation of cost, I think that the liquidity that we saw in the last quarter of last year could have really been inhibited further than what you've already seen and you mentioned earlier today. So I don't think it should be taken lightly. I think it is a problem. I think it does demonstrate the need for improvements from an operational perspective. I think that the transparency of models, the transparency of calculations is significantly important. I know, we weren't going to talk about market risk, but one of the things that we do all the time is try to exchange our models with our clients, right? Because our clients have some of the best models that there are, as you know. And we want to make sure that we're not misaligned. So that transparency is important. The improvement of the process is important. But I think the reality that these things take time, money, and are very, sensitive to the market. I think people need to be a little bit more knowledgeable of some of the information. So I think increased transparency and definitely the ability to quickly react. When we're held back by rule changes, it's really difficult with a very dynamic, as you said, PICOs, right? In a very dynamic marketplace to wait 12 months for a rule change. So I think that the commission has done a great job in trying to be more thoughtful about the approach, and we appreciate that. But I think a lot more work has to be done on that end. So the advocacy is important, the work that's done by STA and SIFMA, the exchanges, OCC, our participants is really important. We need more and more people to drive those communications so that we don't have these issues come up again.
Anything to add? Yeah.
That was a fair summary.
I think that's a really critical point too. Anytime we as an industry are held up by the need for a rule change, it's particularly critical to try to be very proactive about some of these issues, because when we get to the point where there's a major market event or there's something that needs to be addressed urgently, and the commission is held up by, there's an Administrative Procedures Act, right? There are procedures by law they have to go through to get a rule change to become effective. And absent certain emergency measures, it takes a certain amount of time. So when we find ourselves in a position where the SEC's got to change a rule, often it's very, very difficult for that to happen quickly enough. Yeah. Okay. So I'll move on to a related topic. There's been quite a bit of discussion the past couple of months about the SEC's disapproval of the OCC capital plan. And John Davidson, I mentioned this yesterday, and others from OCC have made the point that this is sort of a done issue. It's time to move on from that conversation. I certainly agree, but I'll also say this was a pretty big deal for the industry. This has been something that's been the subject of endless and very expensive discussions and litigation for years now. And I sort of look at that process, and all of your firms are represented, I believe, currently on the board of the OCC. Full disclosure, I've sat on that board as well in the past. There's got to be something that we can learn from this, and look at doing better in the future. I'd be interested in your thoughts on this issue, and on if anything else needs to be done to ensure appropriate operating capital for this essential industry utility going forward.
I'll let you start.
You want me to start? All right. So it's been a very challenging situation, right? And I think that, as we talked about, CCPs looking as a utility, it really needs to be a utility. And this is supposed to be a market structure protection for all of us, right? So whose capital goes first, right? So the end user, the clearing firm, the CCP, the government, right? We have to be careful about that. So we have to keep it in good construct. The capital plan, for all of its faults, I think as we're coming out of that, we really need to focus on the renovation. And it was mentioned about Renaissance and what has to happen. And I think that we, from a clearing perspective, have seen a lot of concerns. The clearing fund was one of them, but we've seen many others that shows and demonstrates to us as a clearing firm that has a significant amount of risk and capital tied up in these markets, and we want to protect the markets, that we need to see this renovation take place. And I think that if we hold the standard that that renovation that should take place from a technology perspective, from a calibration perspective, the models, et cetera, are done, and then we can reduce the cost to run that, I think that then comes back into the industry the right way. I think that the costs are punitive in some ways, but you have to spend the money to get to a better place. So that has to be done. And I just, we know how many challenges there are, but if you look at how many strikes, how much volume there is, the proliferation of exchanges, you can't say that there's not a cost to that expansion. There has to be some cost to that.
Yeah, and I think that's part of the reason why I gave it the kind of C+ trending higher, because I do feel like the right building blocks are in place. I think getting through the kind of previous capital plan discussion and having some closure around that, I think is important for the industry, right? That's closed and we can move on and focus on what are the things that need to be done and lay out, to your point before, Kevin, kind of a very transparent plan on how we're moving forward, right? This is the plan, this is the framework, this is why the ecosystem will function better coming from, moving on from here. When I think about, and I've started to recently spend a lot of time on sort of more CCP waterfalls and engage a lot with the CFTC and more on the future side. When I look at the waterfall from an OCC perspective, it looks a lot different, particularly without the skin in the game layer. So I know there's recently been some discussions about that. We spend a lot of time thinking about what's an appropriate level of skin in the game. How do you measure that on a relative basis? Is it a floor just based on the overall size of the clearing fund, just a hard percentage? But I do think that's something that we need to spend some more time thinking about. So yes, the technology building blocks are important. I think the changes that have been made to the clearing fund, what the new capital plans look like, all important, but I do think we need to factor in a skin in the game layer that's a little bit more robust than what's being considered currently. But I do think, in terms of kind of where we have been and where we're going, we're certainly trending in the right direction, but having closure around the capital plan, I think, is good for the industry.
Yeah.
Yeah, we're kind of step in step with the skin in the game idea that Alicia had brought up, is that when we look at somebody's, how much capital they cover their risk by, we're looking at that not only from our clients. If our client has a risk number, we want them to cover that risk number and probably then some, that'll drive down their RWA number. We think the same for default funds. If there's a risk in the default fund, we would hope that CCP would have some of their own capital in the game to drive down the RWA number that we're calculating on that CCP. Now, we can sit up here for hours and debate what's the right way to calculate the risk number, which I think we all agree is probably not being calculated maybe correctly at the time, but we're all in favor of more skin in the game from the CCPs.
I would agree with him 100%. I spoke with the head of our clearing, and he had said to me, we would like to see a lot more dollars dedicated toward technology, and I know that takes time and it's expensive, but in the end, it will pay off for everyone.
Agreed. We are almost out of time, but I would be remiss if I did not ask, are there any questions for our panel this morning? Everyone's had time to wake up and have some coffee and enjoy a thrilling conversation. Maybe not. Not yet. All right. So then I'll ask the last question, which is, so we kicked off kind of an assessment of the space. Some areas where we're doing well, others where there are room for improvement. Just throw out to the panel generally, what are your biggest concerns? What keeps you up at night when you think about the clearing and risk space that we need to do better at as an industry, maybe that hasn't been discussed so far? Maybe Frank, if you have any thoughts.
The thing that scares me, that Lehman Bear Stearns fiasco really scared the hell out of me. I was managing a very large mini prime, and things like that when they pop up, like how does the industry respond to something like that? And the second thing that scares me is the high frequency traders. Who has a kill switch, who doesn't have a kill switch, and how are the member firms are going to react to that, and what controls can we, as members of the community, how can we influence those customers to make certain that they have the controls in place?
Yeah, I would echo the same thing. I mean, it's the fear of the unknown that keeps us up at night. I mean, we try to do as much risk management ahead of time that we can, and we hope that everything is up to snuff when like a February 5th scenario happens. But for us, it's more the fear of the unknown.
Yeah, I think we spend a lot of time focused on operational risks generally. I think in particular how we think about pre-trade, post-trade checks available at the exchanges, given that speed's a priority for pretty much everyone in this room. How do we think about, for firms going directly, what's the right ecosystem of checks? Right, I've used that word a couple of times, but I think it's important because we all have a role in it. Clearing firms, trading firms, and exchanges all need to play a role in that, and we spend a lot of time thinking about that. I think the partnership has gotten a lot better over the years. I think we've seen a lot of changes on the options give-ups rules, so thank you for that, both from a commission and an exchange perspective. I think it's a long time to get here, but I think we're finally making really good progress, so thanks for that. We're focused on it in the equity space as well, and again, I think some good progress is finally being made. And it's just striking that right balance of no one benefits from a large risk issue that can be game-ending for a firm or a clearing firm. So let's just have the right risk mitigation in place so we don't have another night-like event. So I find 3 a.m. is a particularly good time to worry about that.
Nice.
3 a.m., 4 a.m.
Yeah.
Yeah, I think it's interesting. I think innovation is still lagging behind, and I think it keeps me up because I think when we think about, when we talk about the capital efficiencies and the fact that we've got concentration in the industry, it's because of that inherent cost, right? And we've talked about this a couple times, but the innovation I think that's missing is kind of, cross-product, cross-asset, netting and capabilities that would reduce some of that drag and collateral expenditures that actually inhibit this industry from more growth. So yeah, we had a great 2018, and you could say it could be an aberration, it could be a trend, I don't know yet, but at the end of the day, we'd like to see more growth, right? So product expansion, asset class expansion, better risk modeling, et cetera, and I think that we don't do enough to do that in a quick way. I don't think that we look beyond some of the silos. So everyone wants their little piece of the pie, and that's fine, I get that from a competitive perspective, but I think there's more that we can do that's not competitive, that actually gives people more ability to expand their businesses. And so I'd like to see more innovation. I think what keeps me up at night is we have a situation, and it takes a massive amount of time to correct it because we don't really have a good connected infrastructure to address this situation quickly. And we spend so much time on advocacy trying to get people on board to help provide those protections. And it's interesting that there's resistance to mitigating risk. I don't understand that philosophy. So that's what keeps me up at night.
And what keeps me up at night is the current exposure method. And with that, I want to thank MIAX and OIC, all of you for being here this morning. Great conversation. Thanks to the panelists.
Thank you.
And we'll see you all later. Thank you.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.